The most dangerous Social Security mistake is believing that once your monthly retirement payment begins, that payment is protected from whatever you earn next. It is not. A person can do everything that seems responsible: claim Social Security, take a small job to cover groceries and insurance, deposit every paycheck honestly, and still watch part of a future Social Security payment disappear because one rule was misunderstood. In 2026, if you are below full retirement age for the entire year, Social Security can hold back $1 of benefits for every $2 of work earnings above the annual limit. That does not mean you committed fraud. It does not mean your bank account is suspicious. It means a rule that many people confuse with income tax has quietly been applied to your retirement payment. Pay close attention to this, because the difference between a harmless deposit and earnings that can reduce a Social Security check is not always obvious when you are looking at your bank statement. A pension deposit may not count under this rule. Interest from a savings account may not count. A withdrawal from an IRA may not count as work earnings under this particular rule. But wages, commissions, certain bonuses, vacation pay, and net earnings from self-employment can count. Two deposits can look almost identical on your phone screen and be treated completely differently by Social Security. Most people never realize this until a letter arrives months later. Stay with me through the end, because I am going to give you a simple protection method that can help you estimate the risk before the payment is reduced, report changes before they become a larger problem, and respond correctly if Social Security says you were overpaid. Nobody is going to sit at your kitchen table and explain this in plain English. The bank will not do it. Your employer may not understand it. Even a tax preparer can focus on the IRS side and miss the Social Security side. This is happening quietly, and the people who suffer most are often the ones who believed they were being careful. I have spent decades studying how retirement rules, taxes, banks, credit, and federal benefit systems touch ordinary American households. The pattern is always the same. People do not usually lose money because they were reckless. They lose money because one agency uses one definition of income, another agency uses a different definition, and the notice explaining the difference arrives after the household has already spent the money on rent, food, medicine, utilities, and debt. The system is not one person making a decision against you. It is an invisible mechanism. A payroll record is created, a W-2 is filed, a tax return is processed, an earnings record is updated, a computer compares numbers. A notice is generated. Then a retiree who has worked for 40 years opens an envelope and feels as if the ground moved under the house. Here is the belief I want to remove immediately. Many retirees think there is one retirement age. There is not one age that controls everything. Age 62 is the earliest age when many workers can begin Social Security retirement benefits. Age 65 is still the usual starting point for Medicare eligibility. Full retirement age for Social Security depends on the year you were born and is between 66 and 67 for people now approaching or entering retirement. For anyone born in 1960 or later, full retirement age is 67. These ages are close enough to be confused and far enough apart to cost real money. Imagine a woman named Carol. She is 64. She claimed Social Security at 62 because her husband became ill and the household needed steady money. Her monthly retirement benefit is $1,620. Later, the cost of groceries rises, the property insurance bill increases, and the interest rate on a credit card makes the balance harder to reduce. She takes a part-time office job. She earns $32,000 during 2026. Carol believes she is safe because she is over 62, already receiving Social Security, and not earning what she considers a large salary. But if she remains under full retirement age for the entire year, the 2026 earnings limit is $24,480. Her wages are $7,520 above that limit. Under the basic rule, Social Security may withhold $3,760 in benefits because the reduction is $1 for every $2 above the limit. Now picture what that means in a real home. Carol does not see a neat $313.33 reduction every month. Social Security may withhold whole monthly checks until the required amount has been held back, then make an adjustment. The exact timing depends on the case and the amount of the benefit. A person expecting 12 steady payments can suddenly have a month with no Social Security deposit or a smaller payment than expected. The mortgage company does not care that the reduction came from a federal formula. The electric company does not pause its due date. The pharmacy does not wait for the next recalculation. This is the first open question you need to hold in your mind. If benefits can be held back because of work earnings, are those benefits gone forever? The answer is more protective than many people fear, but it is also more complicated than the simple statement that you get it all back. I will explain that later, because first you must understand what triggers the rule, what does not trigger it, and why a person can still face a painful cash flow loss even when Social Security eventually adjusts the monthly benefit at full retirement age. The second open question is even more important. How does Social Security know what you earned? Many people imagine someone watching each deposit in their checking account. That is not how the retirement earnings test normally works. Social Security looks at wages and net self-employment earnings, using information you report, and earnings information that later appears in federal records. Employers report wages. Self-employed people report business income on tax returns. Social Security maintains an earnings record. The IRS and Social Security are separate agencies, but the numbers created by payroll and tax reporting do not remain isolated forever. This is where modern government feels like silent observation, even when no one is personally watching you. A payroll system sends data. An employer files a W-2. A tax return includes Schedule C or other self-employment information. Computer systems match identifying information. Automated checks identify differences between what was estimated and what was later reported. Some agencies use advanced analytics and automated tools to find errors, unusual patterns, or fraud risk. Banks also use automated transaction monitoring under federal banking rules. But that is a separate system. A bank alert does not automatically mean Social Security will reduce your retirement benefit, and a large bank deposit by itself is not the Social Security earnings test. Confusing these systems creates unnecessary fear. The Federal Reserve influences the interest rate environment that affects savings accounts, mortgages, credit cards, and the cost of borrowing. The IRS decides how income is taxed. Social Security decides how work earnings before full retirement age affect retirement benefits. Medicare uses tax return income from an earlier year to decide whether some people pay higher premiums. Banks follow federal rules designed to identify suspicious financial activity, including certain cash transactions and patterns that may require review. Credit bureaus track debts and payment history to create credit scores. These systems touch the same household, but they do not use the same calendar, the same definition of income, or the same purpose. That difference is the mechanism almost nobody explains clearly. $1 can be harmless in one system and expensive in another. A $20,000 withdrawal from a traditional IRA generally is not wages for the Social Security earnings test, but it may increase taxable income. That higher income may cause more of your Social Security benefits to become taxable. It may also affect Medicare premiums 2 years later if your income crosses an income-related threshold. The same withdrawal can be ignored by one rule and punished by another. This changes everything when you are planning retirement. Most people think they do not qualify for any protection because they assume the government has already made the final decision. That is not always true. Some protections are automatic, but many are not. An appeal is not automatic. A waiver request is not automatic. A request for a lower overpayment recovery amount is not automatic. Correct treatment of a special payment may require proof. An updated earnings estimate requires action. You have to claim the protection that applies to your situation, and you have to claim it before silence turns a small mismatch into a large debt. I want to be careful here. This information is educational. It does not replace advice from a qualified financial planner, tax professional, attorney, or Social Security representative who can review your exact facts. But education matters because you cannot ask the right professional question until you understand where the danger is hiding. The danger begins with a simple decision. A retiree thinks, "I will work a little." That phrase has no legal meaning. Social Security does not use the word little. It uses dollars, dates, age, and the type of income. The difference between earning $23,000 and $30,000 can affect several monthly checks. The difference between earning the money in December and receiving a payment in January can matter. The difference between wages and pension income can matter. The month you reach full retirement age can matter. The first year you retire can have a special monthly rule. The amount of your benefit can change how the withholding appears. And if a spouse or child receives a benefit on your earnings record, your work can sometimes affect their payment too. This is why the problem is larger than a single annual limit. The rule sits inside a household system. A retiree may have Social Security, a small pension, a 401k, a Roth IRA, part-time wages, Medicare premiums, a credit card balance, and a home equity line. Inflation raises the cost of food and insurance. Interest rates raise the cost of carrying debt. A medical bill arrives. The retiree takes more work. The extra wages solve one problem but create another. Then a traditional IRA withdrawal solves the next problem but raises taxable income. 2 years later, a higher Medicare premium appears. Nothing happened on the same day, so the retiree never sees the chain. Watch how this works. The invisible system does not need to be malicious to be dangerous. It only needs to be complicated, delayed, and automatic. A person makes a choice in 2026. A tax form is filed in 2027. A correction or overpayment notice may arrive later. Medicare can look back at an earlier tax year. A bank can change a credit card interest rate according to the account agreement and market conditions. A credit score can fall after a missed payment caused by a benefit interruption. Each institution sees one piece. The retiree lives with the total effect. The first major revelation is this. The Social Security earnings test is not an income test in the everyday sense. It is a work earnings test. That distinction sounds small, but it separates money that can reduce current benefits from money that generally does not reduce them under this specific rule. Wages from a job count. Net earnings from self-employment count. Bonuses, commissions, and vacation pay can count. Pensions, annuities, investment income, interest, veterans benefits, and other government or military retirement benefits generally do not count as earnings for this test. A traditional IRA withdrawal can create tax and Medicare consequences, but it is not treated as wages merely because it entered your bank account. Think about two brothers, both 63. James receives $28,000 from a pension and no wages. Robert earns $28,000 from a part-time job. Their bank accounts may show roughly the same amount of incoming money. Under the retirement earnings test, they are not in the same position. James's pension generally does not count toward the earnings limit. Robert's wages do. Robert could have benefits withheld while James does not, even though both households receive the same number of dollars. That is why looking only at bank deposits can mislead you. A bank statement shows movement. Social Security asks what created the movement. Was it wages, net business income, a pension, interest, a transfer between your own accounts, a gift, an inheritance, a sale of property, a retirement account withdrawal? The source matters. The date the work was performed can matter. The year the money is treated as earned can matter. The system classifies money before it judges the effect. And that leads to the next trap, because even when you correctly identify wages, most people calculate the limit using the wrong age. The age that matters is full retirement age, not the age when Medicare begins, and not simply the age when you first claimed Social Security. For a person born in 1960 or later, full retirement age is 67. For someone born earlier, it may be 66, and a certain number of months. One birthday can move a person from one formula to another, and the month of that birthday can change which wages are counted. If you are below full retirement age for all of 2026, the annual earnings limit is $24,480. Social Security withholds $1 in benefits for every $2 of earnings above that amount. Now consider David, age 63, with a monthly benefit of $2,000. He expects to earn $40,280 in wages during 2026. That is $16,000 above the limit. The basic reduction is $8,000. David may think, I earned an extra $16,000, so I'm still ahead. Perhaps he is. Work can still make financial sense. But he needs to know that $8,000 of expected Social Security cash flow may be withheld during the year. If he planned to use those checks to pay property taxes and health expenses, the timing can hurt even when working remains worthwhile overall. Now change one fact. Suppose David reaches full retirement age in October 2026. A different limit applies to earnings in the months before the month he reaches full retirement age. For 2026, that higher limit is $65,160, and the reduction is $1 for every $3 above the limit. Only earnings before the month of full retirement age are counted under that special formula. Beginning with the month he reaches full retirement age, there is no earnings limit for the retirement earnings test. He can earn wages without this rule reducing his retirement benefit. This is not a small technical difference. A person who turns full retirement age in December does not use the same formula as a person who remains below full retirement age through December. A person who turns full retirement age in January may have almost no exposure to the annual test for that year. A person who turns it late in the year may have many months of wages included. The calendar matters. Here is what almost nobody understands. Full retirement age is not the same thing as the age when you stop paying taxes, because there is no general age when income tax disappears. It is not the same thing as Medicare age. It is not the same thing as age 70, when delayed retirement credits stop increasing a retirement benefit. It is a Social Security control point. Before that point, early claiming and work earnings can interact. After that point, the retirement earnings test no longer limits benefits based on wages, although taxes and Medicare rules can still affect how much money remains in your pocket. Let me slow this down with a kitchen table example. Linda was born in July 1959, so her full retirement age is 66 years and 10 months. She reaches that age in May 2026. She works from January through April and earns $24,000. She also earns another $70,000 from May through December. For the special year rule, Social Security looks at earnings before the month she reaches full retirement age. The wages earned after that month are not counted under the retirement earnings test. Linda may earn far more during the entire year than someone else, and still have little or no benefit withholding under this rule because of when she reached full retirement age and when the wages were earned. Now think about the opposite case. A man named Thomas turns 66 in 2026, but does not reach his actual full retirement age until later because his birth year gives him a full retirement age beyond 66. He assumes his 66th birthday ended the earnings test. It did not. He increases his work schedule, earns above the applicable limit, and does not update his estimate. Months later, his earnings record shows a higher number than Social Security expected. That is how an innocent age mistake becomes an overpayment. If this information is helping you understand a rule that was never explained clearly, leave a like so more retirees and families can find it before they make the same mistake. The second revelation is that Social Security is often working with an estimate before it has the final number. When you apply for retirement benefits and say you will continue working, you may be asked what you expect to earn. That estimate helps determine how much Social Security should pay during the year. But life changes. A person accepts overtime. A part-time job becomes full-time for 3 months. A holiday bonus is larger than expected. A self-employed worker has a strong quarter. An employer pays unused vacation. If the estimate is not updated, the payment can be too high, even though the original estimate was honest. Picture Michael, a 62-year-old veteran who receives a military retirement payment and Social Security retirement. His military retirement generally does not count as wages for the earnings test. He also works at an auto parts store and expects to earn $18,000. In August, another employee leaves, and Michael takes extra shifts. His final wages become $29,000. He sees every paycheck deposited normally. Social Security continues paying the same retirement amount because the agency may still be using the lower estimate. Michael assumes that if the check arrived, he was entitled to it. That belief is dangerous. A payment arriving in your account is not proof that the final calculation is complete. This is not automatic in the protective direction. The system may later discover the mismatch, but it may not automatically know every fact that helps you. It may know the W-2 total without knowing that part of a payment was for work completed before retirement. It may know a self-employment number without understanding when services were performed. It may know that earnings exceeded an estimate without knowing that you stopped work in the middle of the year and qualify for a special monthly rule. Nobody is going to tell you about every exception. You have to raise the issue and provide the facts. The safe action is not to wait for the tax return. If you are under full retirement age and your expected work earnings change, report the new estimate to Social Security. Keep a record of the date, the amount you reported, the method you used, and any confirmation you received. A simple notebook can protect you. Write September 3, 2026, called Social Security. Updated expected wages from $22,000 to $31,500. Spoke with representative. Kept pay stubs. That note may become more valuable than any financial app if a question appears later. Do not rely only on a phone conversation you cannot prove. Save pay stubs. Save year-end wage statements, save letters, save screenshots or confirmation pages from your Social Security account when available. Keep the envelope from an important notice because the date received can matter. If you mail a form, use a method that gives you proof of delivery. Ordinary people often lose arguments not because they are wrong, but because they cannot show what they reported and when they reported it. The third revelation concerns what counts as wages and when it counts. Social Security generally counts wages when they are earned, not simply when they are paid. That becomes important when a person retires late in one year and receives a bonus, commission, unused vacation payment, sick pay, or deferred compensation in the next year. Some payments received after retirement may be special payments for work performed before retirement and may not count toward the earnings limit for the later year. Consider Mr. DeLuca. He retires in November 2025 at age 63. In January 2026, his former employer pays him $20,000 for unused vacation earned before he retired. The deposit arrives in 2026 and may appear on a wage statement, but the payment relates to earlier work. Social Security has procedures for special payments, and employers may need to provide information showing when the money was earned. If Mr. DeLuca assumes the system will recognize this automatically, he may receive a notice that treats the payment incorrectly until he supplies proof. Now, consider a salesperson who continues receiving renewal commissions after retiring, or a farmer who receives income from crops carried over from earlier work, or an executive who receives deferred compensation after leaving employment. These are not everyday situations for every retiree, but they reveal the larger truth. The date money enters the bank is not always the date Social Security considers it earned. The label on the payment and the work behind it matter. At the same time, do not make the opposite mistake and assume every bonus is protected. A bonus earned for work performed during 2026 can count in 2026, even if you mentally treat it as extra money. Commissions can count. Vacation pay can count. Employee contributions to a pension or retirement plan may still be included in gross wages for this purpose. A person can look at take-home pay after 401k contributions and calculate the earnings limit using the smaller number, while Social Security looks at gross wages included in the wage record. Let us use a clear example. Susan earns $2,300 per month before deductions at a part-time job. Her paycheck after taxes, health insurance, and a 401k contribution is only $1,720. She looks at the money that reaches her checking account and thinks she will earn about $20,640 during the year, but her gross wages are $27,600. The earnings test generally looks at the wage amount, not the smaller amount deposited after deductions. Susan can cross the 2026 limit even though the cash she actually receives feels modest. This helps both lower-income retirees and comfortable middle-class retirees because both groups can be fooled by take-home pay. A lower-income retiree may work at a grocery store and contribute a small amount to a retirement plan. A middle-class retiree may do consulting and make estimated tax payments. Both can see less money in the bank than the earnings figure used by Social Security. The system measures the income category, not the feeling of how much money was left. Self-employment creates another layer. Social Security generally counts net earnings from self-employment, not gross customer payments. But net does not mean whatever remains in the checking account. It means business income after allowed business expenses under tax rules. A self-employed retiree can receive $50,000 from customers, spend $20,000 on legitimate business expenses, and report $30,000 of net earnings. That net figure is generally what matters for the earnings test. But the timing rules for self-employment can differ from wage timing, and the amount may not be final until the tax return is prepared. This is where people who sell online, drive for delivery services, repair homes, provide bookkeeping, care for pets, or do consulting can be caught. They do not think of themselves as running a business. They think they are making a little extra money. But the tax system may treat the activity as self-employment. The retirement earnings test does not care whether you have an office, employees, or a business sign. It cares about net earnings from work. A retiree named Evelyn sells handmade quilts online. She receives $18,000 through payment platforms and another $9,000 by check. She spends $8,000 on fabric, shipping, online fees, and equipment. Her net business income may be around $19,000 before other adjustments, which is below the 2026 earnings limit if she has no other work earnings. But if she also earns $9,000 helping at a local shop, the wages and net self-employment earnings can combine. She may cross the limit even though neither activity alone seemed large. Now notice the quiet monitoring mechanism. Payment platforms may issue tax information when reporting rules apply. Banks record deposits. Employers file wage reports. The IRS receives a tax return. Social Security updates earnings records. No single screen needs to show Evelyn's whole life in real time. The system can still reconstruct the number later. That delay is what creates danger. By the time the final number appears, the Social Security payments may already have been spent. The fourth revelation is a special rule that can protect someone in the first year of retirement, but only if the facts are recognized. Social Security has a monthly earnings test that can apply in a grace year, often the first year a person retires. This matters when someone earns more than the annual limit before retiring, but then stops or sharply reduces work. Suppose Anthony earns $80,000 from January through August 2026, retires in September at age 63, and begins Social Security. If Social Security used only the annual limit, Anthony would appear far above $24,180 and could lose all benefits for the remaining months. The special monthly rule may allow him to receive a full benefit for a month considered retired, even though his total annual earnings were high. In 2026, a person under full retirement age for the entire year is generally considered retired for a month under this special rule if monthly earnings are $2,040 or less and the person does not perform substantial services in self-employment. The phrase substantial services matters for self-employed people. A business owner cannot simply stop taking a paycheck while continuing to manage the business full-time and assume the person is retired for that month. Social Security may look at time, duties, skill, and the nature of the work. A family business can make this especially confusing. A retiree may transfer ownership on paper, but still open the store, order inventory, supervise employees, and make decisions every day. The system can view those services as work, even if the bank deposit is small. For someone reaching full retirement age in 2026, the monthly amount under the special rule is higher, $5,130 for months before full retirement age, along with the rule about not performing substantial self-employment services. The point is not to memorize every number forever. These amounts can change each year. The point is to recognize the question. If you retire in the middle of a year after earning above the annual limit, ask whether the special monthly rule applies. This is not automatic in every case, and most people think they do not qualify because they only see the annual wage total. Imagine Anthony's relief when he learns that his January through August earnings do not necessarily erase his September through December checks. But now, imagine he never asks. He receives a notice based on the annual number, feels defeated, and accepts it. That is why you have to claim the protection. The rule exists, but a rule you do not raise can be almost as useless as a rule that does not exist. The next trap is more painful because it can affect not only the worker's payment, but the household's payment. When a retired worker's benefits are withheld under the earnings test, benefits paid to a spouse or child on that worker's record can also be withheld for the same months in many situations. A retiree may think the risk is limited to one check, but the household may depend on 2 or 3 payments connected to the same earnings record. The effect can be much larger than expected. Picture Frank, age 64, receiving $2,100 per month. His wife, Maria, receives a spousal benefit on his record. Frank returns to work because their roof needs replacement. He focuses only on his own benefit and calculates that a few checks may be withheld. He does not realize that Maria's payment can also be affected when his benefit is withheld because of his work. The $18,000 roof repair creates pressure. The extra work creates earnings. The earnings reduce benefits. The reduced household income pushes expenses onto a credit card. The credit card balance carries an interest rate above 20%. One unplanned rule touches retirement, banking, credit, and household security at the same time. This is why I do not tell people to stop working. Work can increase income, provide health coverage, improve future Social Security calculations if new earnings replace a lower year in the 35-year record, and give people purpose. The right lesson is not never earn above the limit. The right lesson is calculate the full household effect before you depend on every Social Security payment. Social Security benefits are generally calculated using up to 35 years of covered earnings. If you work after claiming and the new year is higher than one of the years used in the calculation, Social Security reviews the earnings record and may increase the benefit. That increase is separate from the earnings test. One rule may withhold current payments while another rule may later raise the monthly amount because of new earnings. Again, the systems do not move on the same schedule. Now I can answer the open question from the beginning. Benefits withheld under the retirement earnings test are not treated as permanently lost in the same way as a fine. When you reach full retirement age, Social Security recalculates your benefit to give credit for months in which benefits were withheld because of excess earnings. The result can be a higher monthly benefit for the rest of your life. But do not turn that into the dangerous sentence, "It does not matter because I get every dollar back." You do not normally receive a simple lump sum refund on your full retirement age birthday. Social Security adjusts the reduction applied when you claimed early, crediting months for which full benefits were withheld. The value returns through a higher monthly payment over time. How long you live, how many months were withheld, family benefit rules, and your personal cash needs all affect how valuable that future increase feels. For a household behind on bills, money restored gradually years later is not the same as money available now. A missed mortgage payment can damage credit now. A high credit card balance can create interest now. A delayed dental procedure can harm health now. A family loan can create tension now. The future recalculation is real protection, but it does not erase the immediate cash flow shock. Think of it like water being redirected. The water is not necessarily destroyed, but it does not reach the part of the garden that needs it this month. Later, the flow may be increased. That does not revive a plant that died during the dry period. Retirement planning must respect timing, not only lifetime totals. Now tell me in the comments, did you already know that withheld benefits can lead to a higher monthly amount at full retirement age, or is this the first time anyone has explained the difference between withholding and permanent loss? The fifth revelation is that the amount shown as your Social Security benefit is not always the amount that reaches your checking account. Medicare premiums, voluntary federal tax withholding, overpayment recovery, certain legal obligations, and other deductions can change the deposit. A retiree can receive a cost of living adjustment and still see a smaller increase than expected because another deduction rose. In 2026, the standard Medicare Part B premium is $202.90 per month for most people, and the annual Part B deductible is $283. Many retirees have the Part B premium taken directly from the Social Security payment. If a monthly Social Security benefit is $1,700, the bank deposit can already be lower because Medicare is taken out before the money arrives. If the person also requests federal tax withholding, the deposit falls again. Social Security allows voluntary federal income tax withholding at rates of 7%, 10%, 12%, or 22%. This can protect a retiree from a large tax bill, but it also means the amount deposited is not the full benefit amount. People often compare this month's bank deposit with last month's deposit and assume Social Security changed the basic benefit. Sometimes the change is a deduction. Federal taxation of Social Security uses a separate formula. The IRS looks at 1/2 of Social Security benefits plus other income, including tax-exempt interest. If that combined amount exceeds $25,000 for many single filers or $32,000 for married couples filing jointly, part of the benefits may become taxable. These thresholds are not the same as the 2026 Social Security earnings limit. A person can be below the work earnings limit and still owe tax on benefits. Another person can be above the work earnings limit but have a different tax result. Never use one threshold to answer the other question. Consider Nancy, single, age 64. She receives $24,000 in annual Social Security benefits and earns $20,000 from a job. Her work earnings may be below the 2026 retirement earnings limit, so the earnings test may not reduce her benefits. But for federal tax purposes, 1/2 of her Social Security is $12,000. Add the $20,000 of wages and the combined amount becomes $32,000 before considering other income. She may owe federal income tax on part of her Social Security. No benefit withholding under the earnings test does not mean no tax. Now consider George and Helen, married and filing jointly. Together they receive $42,000 in Social Security and withdraw $35,000 from a traditional IRA. The IRA withdrawal generally is not work earnings for the retirement earnings test, but it can increase taxable income. One half of their Social Security is $21,000. Add the traditional IRA withdrawal and they reach $56,000 before other income. Part of their Social Security may become taxable. A withdrawal that does not reduce the benefit under one rule can still increase the IRS bill under another. The sixth revelation is that income can also change Medicare premiums on a delayed schedule. Medicare generally uses modified adjusted gross income from the tax return 2 years earlier to determine whether a person pays an income-related extra amount for Part B and Part D. For 2026, the standard Part B premium is $202.90. A person with 2024 income above $109,000 on an individual return or above $218,000 on a joint return can pay more. The first higher 2026 Part B tier is $284.10 per month. Higher tiers rise to $405.80, $527.50, $649.20, and $689.90 depending on filing status and income. Part D can also carry an income-related extra amount. This is why a large traditional 401k or IRA withdrawal can echo 2 years later. The retiree spends the money in 1 year, files the return the next year, and sees a higher Medicare deduction later. The delay hides the cause. A comfortable middle-class couple can be caught without feeling wealthy. Suppose Robert and Elaine usually report $180,000 of joint income. They sell investments, take an extra $50,000 from a traditional IRA for a home renovation, and reach $230,000 of modified adjusted gross income. 2 years later, both may enter a higher Medicare premium tier. The extra monthly cost applies to each spouse enrolled in Medicare Part B. A threshold crossed by a few $1,000s can produce a much larger household cost than expected. There are procedures to ask Social Security to use a more recent tax year after certain life-changing events, such as retirement, marriage, divorce, death of a spouse, loss of income-producing property, loss of pension income, or an employer settlement payment. This is another example of a protection that is not always automatic. If income fell because you retired, Social Security may not know until you report the life-changing event and provide evidence. Most people think they do not qualify, but many ordinary retirees do. You have to claim it. The form commonly used to request a lower income-related Medicare amount after a qualifying life-changing event is SSA 44. The form asks about the event, the year income changed, an estimate of modified adjusted gross income, and proof. The lesson is not to complete a form blindly. The lesson is to recognize a notice showing a higher Part B or Part D amount, compare the income year used, and ask whether a recognized life event makes a newer year more appropriate. This helps both lower-income retirees and comfortable middle-class retirees. A lower-income retiree may need help with Medicare costs through programs that are not automatic in every case. A middle-class retiree may need to challenge an income-related premium based on an old high-income year. Different households need different protections, but the common requirement is attention. Now add required minimum distributions. Traditional IRA and many retirement plan owners generally must begin required withdrawals at age 73 under current rules. These withdrawals can increase taxable income. They do not become wages for the Social Security retirement earnings test merely because they are required, but they can cause more Social Security benefits to be taxable and can affect future Medicare premiums. A retiree may say, "I did not choose this income. The law required me to withdraw it." Medicare and the IRS still use the tax numbers created by the withdrawal. The system does not measure whether the income felt voluntary. It measures how the law classifies it. Roth IRA planning can matter because qualified Roth distributions generally do not enter taxable income the same way traditional IRA withdrawals do. But moving money from a traditional account to a Roth through a conversion can create taxable income in the conversion year. A conversion may be sensible over a lifetime and still raise Medicare premiums later if it crosses a threshold. There is no single move that is good under every rule. Inheritance adds another layer. Cash or property received as an inheritance is generally not included in income merely because it was inherited, although income later produced by inherited property can be taxable. An inherited traditional IRA is different because taxable distributions generally enter the beneficiary's gross income. A widow can inherit a retirement account, take a large distribution to pay debts, and unintentionally increase the taxable portion of Social Security or future Medicare premiums. People call this inheritance tax. But the practical household problem is often income tax on what comes out of the inherited retirement account, not a federal tax on receiving ordinary inherited cash. This is why financial planning must separate the containers. A checking account is one container. A traditional 401k is another. A Roth IRA is another. A taxable investment account is another. A pension is another. Social Security is another. The same $30,000 taken from different containers can create different tax, Medicare, and benefit results. The seventh revelation concerns banking rules and financial monitoring. Many older Americans are frightened by claims that every transfer over a certain amount is automatically taxed, or that every bank deposit changes Social Security. Those claims are misleading. Federal banking rules do require financial institutions to keep records and report certain activity. Cash transactions above $10,000 in a day can trigger a currency transaction report. Banks also monitor for suspicious patterns under the Bank Secrecy Act. But a report is not a tax, not an accusation, and not the Social Security earnings test. Do not structure cash deposits to avoid reporting. Breaking one large cash deposit into smaller deposits to evade a reporting requirement can itself create serious suspicion. At the same time, do not panic because you made a legitimate large deposit from the sale of a car, an inheritance, or a transfer from another account. Keep documents showing the source. The protective habit is simple. Legitimate money should have a clear paper trail. Banks use software to review transactions, detect unusual patterns, and create alerts for human review. Credit card companies use models to detect fraud. Credit bureaus use account history to calculate scores. Government agencies use data matching and automated checks. People use the phrase artificial intelligence for all of this. But not every automated rule is intelligent, and not every alert means wrongdoing. The real risk for retirees is often not surveillance itself. It is a mismatch between systems that the retiree cannot explain because records were not kept. Suppose a retired contractor deposits $12,000 in cash from selling a classic motorcycle. The bank may complete required reporting because of the cash amount. That report does not turn the sale into wages. If the motorcycle was a personal asset, tax treatment depends on basis and gain, not the size of the bank deposit alone. Social Security does not automatically apply the retirement earnings test merely because the checking balance increased. But without a bill of sale, proof of ownership, and records of what he paid, the retiree may struggle to explain the transaction later if a question arises. Now suppose the same retired contractor receives $12,000 in cash for renovation work. That is business income. The bank deposit looks similar, but the source is different. Net self-employment earnings can affect the retirement earnings test before full retirement age, and business income must be handled correctly for tax purposes. The system does not judge the shape of the deposit. It judges the activity behind it. This is the quiet betrayal people feel. They followed the bank's instructions. They paid taxes for decades. They trusted that a deposited government check was final. Then a later record changes the conclusion. The bank did not promise Social Security eligibility. Social Security did not promise the tax result. The IRS did not promise the Medicare premium. Each institution stayed within its lane, and the retiree fell into the gap between the lanes. That gap becomes most dangerous when a normal work decision turns into an overpayment notice. An overpayment means Social Security believes you received more than you were entitled to receive. That can happen because earnings were higher than estimated, a work change was not reported, agency records were updated late, a family situation changed, or a calculation was corrected. The word sounds administrative. The effect can be brutal. Imagine Harold, age 63, receiving $1,900 per month. He reports expected wages of $20,000. His employer loses workers, and Harold's final wages become $38,000. He does not report the increase because he assumes payroll reports everything immediately. Social Security continues paying the regular benefit. The next year, wage records show the higher amount. Social Security determines that benefits should have been withheld. Harold receives a notice saying he was overpaid by several $1,000s. Harold's first reaction is shame. He thinks the letter accuses him of stealing. It may not. An overpayment can exist without fraud. His second reaction is fear. He has already used the money for ordinary living expenses. His third reaction is silence. That is the most expensive reaction. Under current Social Security procedures, if a person does not repay or take action after an overpayment notice, the agency can automatically withhold 50% of the monthly Social Security benefit for recovery, while the usual SSI recovery rate is different. On a $1,900 retirement benefit, 50% is $950. A household that was barely stable can lose nearly $1,000 of monthly cash flow until the debt is recovered. This is the hidden rule that turns a small reporting mistake into a financial emergency. The agency's computer does not know that the refrigerator broke, that rent rose, or that a spouse needs medication. It sees a debt and applies a recovery process. The gears move silently. The notice is created. A response period begins. If nothing interrupts the process, part of the next payments can be taken. There are 3 different responses, and choosing the wrong one wastes time. If you believe Social Security is wrong about whether an overpayment occurred or wrong about the amount, you can request reconsideration, commonly using Form SSA 561. The general appeal period is 60 days after receiving the notice. But acting within 30 days is especially important because a timely appeal or waiver request can stop collection while Social Security decides the request. If you agree that an overpayment occurred but believe it was not your fault and you cannot afford repayment or recovery would be unfair under the rules, you can request a waiver, commonly using Form SSA 632-BK. A waiver asks Social Security not to collect some or all of the debt. You do not win by writing only, "I spent the money." You must explain why you were not at fault and why repayment creates hardship or meets another waiver standard. Household income, expenses, assets, notices, and reporting history matter. If you agree that you owe the money but cannot survive a 50% reduction, you can request a lower recovery rate using Form SSA 634. You show necessary living expenses and propose an amount you can manage. This is not automatic. Nobody is going to tell you about this at the moment fear makes you freeze. You have to claim it. The strongest file is built before the notice arrives. Keep the original earnings estimate. Keep proof of every update. Keep pay stubs. Keep tax forms. Keep employer letters about special payments. Keep a monthly record of gross wages, not only take-home pay. Keep notes of calls. Keep copies of forms. When a notice arrives, read every page, mark the date received, identify the amount, identify the period, and compare the agency's number with your records. If you want to keep receiving clear warnings like this before a quiet rule affects your retirement money, consider subscribing to the channel and activating notifications so you do not miss the next explanation. Now I want to give you the protection method I promised. I call it the 4-number check. You can write it on one sheet of paper. First, write your exact full retirement age and the month you reach it. Second, write your expected gross wages and net self-employment earnings for the current year. Third, write the Social Security earnings limit that applies to your age and year. Fourth, write the amount of Social Security cash your household needs each month after Medicare, taxes, and other deductions. Then update those 4 numbers whenever work changes. If overtime appears, update the wage estimate. If a bonus is announced, ask when it was earned and whether it counts. If you stop work mid-year, ask about the special monthly rule. If you receive a payment for work performed before retirement, ask whether it is a special payment and get employer proof. If an overpayment notice arrives, do not wait for the next deposit to see what happens. This method is simple because complicated plans often fail under stress. A retiree does not need a wall of spreadsheets to notice that expected wages moved from $22,000 to $30,000. The person needs one clear number, one call, one record, and one follow-up. Here is the climax that most people never see until years have passed. Retirement income is controlled by different clocks. Social Security's earnings test watches work earnings before full retirement age. The IRS looks at annual taxable income. Medicare can look back 2 years for income-related premiums. Banks watch transaction patterns in real time. Credit scores react when payments are missed. Required retirement withdrawals begin according to age. An inherited IRA can force planning within its own distribution rules. These clocks do not ring together. A person can make a decision that looks safe on the Social Security clock and expensive on the Medicare clock. A traditional IRA withdrawal does not count as wages for the earnings test, so the Social Security check continues. The withdrawal raises taxable income, so more Social Security becomes taxable. 2 years later, Medicare premiums rise. The retiree thinks the current Social Security payment was protected, but the same decision reduced future net payments through another door. Another person can make a decision that looks safe on the tax clock and dangerous on the Social Security clock. A part-time worker has enough tax withheld and owes nothing at tax time. Because taxes were handled correctly, the person assumes every federal rule was satisfied, but wages exceeded the earnings limit before full retirement age. Social Security later creates an overpayment. Paying the IRS correctly did not protect the Social Security check. A third person can make a decision that looks safe on the bank clock and dangerous everywhere else. Every deposit clears. No fraud alert appears. The checking account looks normal. But the deposits are self-employment income that was never added to the Social Security estimate. The absence of a bank problem is mistaken for proof that the benefit is correct. It is not. This is the silent machine. Payroll sends wages, tax returns report income, Social Security updates earnings, Medicare uses earlier tax data, banks deduct premiums and debts from the cash that remains. Creditors charge interest when income is interrupted. Algorithms do not need to know your story. They only need to compare fields and apply rules. The most important protection is not hiding money, moving deposits, or trying to outsmart reporting. Those actions can create far greater problems. The protection is classification, timing, documentation, and action. Know what kind of money you received. Know when it was earned. Know which agency uses it. Keep proof. Respond before the deadline. Remember the central truth. Benefits withheld under the retirement earnings test are credited through a recalculation at full retirement age. They are not simply treated as a permanent punishment, but the cash flow damage before that age can be real. An overpayment can create recovery from future checks. Tax can reduce what you keep. Medicare can reduce what reaches the bank. Interest can consume the gap. The word temporary does not mean harmless. I have seen too many people blame themselves for systems they were never taught to read. A widow opens a notice and thinks she failed. A veteran sees a smaller deposit and assumes a benefit was canceled. A middle-class couple crosses a Medicare income line by a few $1,000s and wonders why 2 checks changed. A self-employed retiree calls a profitable month a blessing, then receives an overpayment letter later. These are not foolish people. They are people dealing with rules written in separate rooms. You still have power. You can check your full retirement age. You can estimate gross wages instead of take-home pay. You can report changes. You can ask about the first-year monthly rule. You can identify special payments. You can review your Social Security earnings record. You can plan IRA withdrawals with taxes and Medicare in mind. You can appeal a wrong decision. You can request a waiver when the rules allow it. You can ask for a lower recovery rate when the proposed amount would take away money needed for food, housing, medicine, and utilities. Do not let fear make you ignore an envelope. Do not let embarrassment keep you from asking for an explanation. Do not assume a government payment is final merely because it arrived. Do not assume a bank deposit is wages merely because it is large. Do not assume money is harmless merely because it is not wages. The right question is always, how does this specific system classify this specific dollar? Sit down with your spouse, an adult child you trust, or a qualified professional. Put the notices on the table. Write the dates. Circle the income year. Compare the gross wage number. Look at the month of full retirement age. Separate wages from pensions, investments, and retirement account withdrawals. Then decide what must be reported, what must be challenged, and what must be planned. This is not about becoming afraid of work. It is about making work serve you instead of allowing a hidden timing rule to control your household. It is not about distrusting every bank employee or government worker. It is about understanding that large institutions process categories, while you live with consequences. It is not about becoming a tax expert. It is about knowing when $1 is being treated 3 different ways. You work too long to let confusion take control now. The house, the savings, the retirement account, the monthly benefit, and the peace inside your home were built 1 paycheck at a time. Protecting them begins with attention. There is still time to correct an estimate, organize records, ask for a review, or change the timing of a financial move before it creates a larger cost. Share this information with a spouse, a brother, a sister, a friend from work, or anyone who claimed Social Security before full retirement age and still earns money. One clear explanation can prevent months of fear. And if you think this rule is important, watch the next video appearing on the screen. In that video, I explain another quiet retirement mistake that can reduce the money reaching your bank account even when your official Social Security benefit goes up. Protecting retirement is not about chasing secrets. It is about learning the rules before the rules are applied to you.